Have you ever been driving and suddenly the weather just turns? You hit a patch of sog, maybe some gusty wind kicks up, things feel a bit uncertain,
Yeah.
but then you start to see breaks in the clouds, the sun peeks through. That's actually, well, it's a pretty good way to picture the global private markets landscape, navigating through 2024 and looking ahead into 2025.
It really is. And it captures that paradox of the last year, doesn't it? Significant headwinds, real challenges, but also clear signs of adaptation, people finding ways forward.
Exactly. And that dynamic, that's what this deep dive is really all about. We're going to unpack the state of global private markets, and we're using a fantastic source, the McKinsey Global Private Markets Report for 2025.
Right. And our goal here together is to pull out the key insights from this really comprehensive report, find those, surprising bits, and figure out what it all actually means for you, whether you're deep in the industry or just trying to stay informed about this, well, massive part of the financial world.
Yeah, it's crucial. We'll look at how different corners of private markets did and what trends are really shaping things going forward.
So just jumping in with that high-level view from the report, 2024, it definitely had some mixed signals.
They really did. On one hand, you saw headline deal-making and fundraising looking pretty well subdued.
Yeah, lowest levels globally since 2016, actually.
Wow. And that was even while public markets, stocks were having a pretty strong run.
But, and this is where it gets interesting, right? Counter to those sort of slower headline numbers, capital deployment actually went up in 2024.
Okay, so money was still being put to work.
A lot of it. The report says double-digit increases across asset classes, so managers weren't just sitting on cash. It suggests they were adapting, finding ways to invest, even with structurally higher interest rates.
And maybe the most telling part, investor confidence, the LP perspective.
Mhm.
It stayed really strong.
Very strong. That McKinsey survey of leading LPs in the report, it's quite clear. Investors aren't backing away. They actually plan to allocate more capital, not less, over the coming year.
Okay, so what's driving that picture? Challenges, but also deployment and this forward-looking confidence.
Well, a few big things. Structurally higher interest rates, that's huge. It really shook up industries like private equity that got used to cheap leverage, and it made figuring out company earnings more complicated.
And then the bigger picture stuff.
Right. Geopolitical instability, shifts in trade policy, that adds uncertainty to everything. Deals, operations, global supply chains.
And you can't ignore tech, especially AI.
Definitely not. Generative AI is forcing firms to build new muscles, new capabilities, rethink how they actually create value in the companies they own.
But the report highlights resilience, right? Adaptation.
Yeah, that really stands out. Stakeholders are reacting. Fundraisers are looking beyond just the traditional closed-end funds, maybe using things like evergreen vehicles for more flexible capital.
And the deal makers, the operators?
They're focusing less on just, let's say, financial engineering, hoping for an easy multiple bump. It's much more about driving real, deep operational changes in the businesses.
Makes sense.
And the investors, too, the LPs. They're evolving. Not just passively allocating to funds, but some are actively investing in the GP firms themselves. You see that in the buzz around secondaries and GP stakes. It's a different way to play the growth.
Okay, let's unpack that a bit more, starting with that overall market view. You mentioned the mixed conditions, low fundraising and deal value compared to recent years, but strong public markets. Why the disconnect?
Well, private markets, they often lag the public ones, right? Public markets react almost instantly to sentiment shifts, rate expectations. Private deals are slower. Sourcing, diligence, negotiation, it all takes time.
And valuations don't move as fast.
Exactly. Especially valuations held on GP's books. So there's probably a gap, a mismatch in price expectations that slowed things down initially.
But then that counter trend, the double-digit increase in deployment, how did managers pull that off if fundraising was down?
Good question. A couple of things, likely. First, they had dry powder, capital raised in previous busier years.
Leftover cash.
Right. Second, they found ways to make deals work even in the new rate environment. The financing conditions did get a bit better later in the year, which we can touch on. And third, it suggests capital flowed into maybe different types of deals or structures where deployment was still attractive.
And the LP survey numbers backing this confidence, they're pretty striking. You mentioned percentages planning to increase.
Yeah, despite maybe some recent fund performance looking a bit muted, LPs are definitely playing the long game. The survey showed 30% plan to up their private equity allocations, 43% for private debt, that was the highest actually, and 46% for infrastructure, also very high.
So this isn't just passive allocation, it's like strategic intent.
Exactly. Strategic intent.
So despite the headwinds rates, geopolitics, AI, the underlying belief in private markets seems solid.
Absolutely. Look, the market's adjusting. Higher rates seem like they're here to stay for a bit, forcing a reset from that, easy money period. That pressure plus the geopolitical shifts plus AI disruption.
Yeah.
The old playbook just isn't enough anymore.
And that's where the resilience comes in. You mentioned fundraisers, looking at evergreen funds. Why are those appealing now?
Well, evergreen funds, or things like non-traded REITs and BDCs, they're structured differently. They offer investors more frequent chances to get their money out compared to a traditional 10 or 12-year lockup.
More liquidity options.
Right. And that appeals to a wider range of investors, including the retail market and maybe institutions that need different liquidity profiles. It's meeting investor needs beyond just the standard offering.
And the shift towards operational transformation for deal makers? That sounds critical.
It's absolutely crucial. With borrowing costs higher, you can't rely so much on leverage to juice returns. And if entry multiples are still kind of high from the peak, you can't just count on selling for way more later.
So value has to come from the business itself.
Exactly. Improving the core business.
Yeah.
Growing revenue, cutting costs, making operations better. That takes a different skill set inside the PE firm, right? More operators, data people, AI experts maybe.
And LPs investing in the GPs. What's driving that?
It seems to be a desire for more control, maybe more tailored exposure, and participating directly in the economics of the management companies themselves, which are growing businesses. It's a sign that LPs are getting more sophisticated, more demanding in how they access the market.
Okay, let's dig into the different asset classes then. Navigate the specific terrains. Starting with private equity, the report suggests it's, emerging from the fog?
Yeah, that's a pretty good description. PE definitely hit a rough patch in 2022, 2023. Those rapid rate hikes, after a decade of nearly free money. It really shook an industry often built on cheap leverage. Plus, macro uncertainty didn't help.
But 2024 saw activity bounce back.
Yeah, a significant bounce. Deal-making jumped 14%, hitting $2 trillion, which, actually made 2024 the third most active year ever for PE deals by value.
Wow. What fueled that rebound?
Things got a little easier on the financing front. Rates were still higher, sure, but the cost of buy-up financing dipped a bit. And new loan volume for PE deals nearly doubled compared to 2023.
So financing became more available.
Seemed like it. And we even saw entry multiples tick up slightly, suggesting sponsors felt they could pay a bit more again, maybe due to that financing or maybe a better outlook for operations.
And LP confidence, as we said, solid here too. 30% planning to increase allocations.
Right. They look at PE for its long-term performance. The report notes it's actually beaten the S&P 500 since 2000, plus the diversification benefit.
But the fog hasn't lifted everywhere in PE.
No, definitely not. Venture capital, for instance, is still facing some pretty strong headwinds. It saw a bigger drop in deal count, nearly 17% down, and slower growth in deal value, only up about 6.7%.
And performance lag too.
Yeah, VC underperformed buyout on IRR in 2024. Seems like the revaluation of high-growth tech assets hit VC harder, and finding agreement on price is still tricky.
And you mentioned Asia lagging.
Significantly. Across the board, really. Fundraising down over 30%, AUM down over 5%, mainly driven by folks pulling back from China due to regulatory and geopolitical worries.
So what are the big ongoing challenges for PE overall?
Well, there's the hangover from those high-priced deals done in 21 and 22. A lot of those are still on the books. And crucially, this historic exit backlog.
The logjam of companies waiting to be sold.
Exactly. The number, the value, the share of companies held longer than usual. It's bigger than it's been in 2 decades, according to the report. Selling those is tough when many are still marked higher than what the market seems willing to pay right now.
Which makes fundraising harder too, right? LPs want their money back first.
Absolutely. DPI distributions to paid-in capital, that's a huge focus for LPs now. Refinancing older deals is also tricky with higher rates. And, like we touched on, firms have to get serious about AI, building the teams, figuring out how to use it to actually create value, not just talk about it.
Okay, moving over to real estate. Sounds like another mixed year, but maybe with signs of renewed growth.
Definitely mixed. Fundraising for real estate funds actually slowed down quite a bit, down 28% to about $104 billion, lowest since 2012.
Ouch.
Yeah. But on the other hand, deal activity and performance relative to other asset classes looked stronger.
Deal value picked up.
It did, up 11% in 2024. That was the first increase since 2021, so it reversed that downward trend. Certain sectors did particularly well, like multifamily housing up 20% and industrial up 16%.
What helped drive that rebound?
Again, a slightly better financing environment played a role. Some rate cuts helped make deals pencil out, and we saw more CMBS issuance, those commercial mortgage-backed securities, which helped lower borrowing costs for some.
And supply and demand.
Yeah, supply fell off. Construction starts dropped quite a bit for industrial and multifamily in the U.S. That helped balance things. And cap rates compressed a bit in some areas, meaning yields went down, values went up, signaling some stabilization.
But rent growth is slowing down in the traditional areas.
It is, yeah. Multifamily rent growth was down to like 1.1%, industrial around 2.1% late last year. The huge exception, data centers. Rents there were up, nearly 13% in the U.S.?
Wow. Which really underscores that shift towards needing operational chops in real estate, right?
Absolutely. If rent growth is slowing and you can't just rely on the market lifting all boats through cap rate compression, value has to come from active management.
Improving the buildings, the tenant experience.
Exactly. Using data better, delivering services efficiently. The report shows investors with those operational capabilities are gaining market share. Their slice of AUM is up significantly over the last 10 years.
And there's that big refinancing challenge looming.
A huge one. The report calls it a looming wall of maturities. Something like $2.1 trillion of the $4.8 trillion in U.S. commercial real estate loans are maturing in the next 3 years.
That sounds like a risk.
It's a risk for many owners, for sure, but also a massive opportunity for private debt folks or strategic buyers who have capital ready.
Interesting. But despite that opportunity, you said dedicated real estate debt fundraising was down sharply.
It was, down 44%. The thinking in the report is that maybe capital is flowing into broader opportunistic or special situation funds that can invest flexibly rather than just pure real estate debt funds. Could also be some structural issues within LPs where real estate and credit teams are separate.
Got it. And those alternative sectors are still the place to be.
Yeah, data centers, manufactured housing, senior housing. They outperform traditional sectors for the third year running, and they often need that specialized operational know-how we talked about.
Okay, let's shift to private debt. Sounds like it was maybe the steadiest ship in the storm during 2024.
It really seemed to prove its resilience, yeah. While other areas saw some declines, private debt deal-making actually grew. New LBO financing was up 30% in the U.S. and Europe, helped by that PE buyout rebound and better borrowing conditions.
What were some key trends you saw in the deals themselves?
Well, financing spreads came down a bit. That's the extra yield borrowers pay over a benchmark. The gap between direct lending spreads and broadly syndicated loans, or BSLs offered by banks, it narrowed somewhat.
So direct lending may be getting slightly less expensive relative to banks.
Seems that way. And maybe because of that, the syndicated lenders did claw back some market share on the bigger LBO deals last year. Direct lending share of the value fell from about 64% down to 54%.
Where are private debt managers getting their capital? You mentioned permanent capital.
Yeah, increasingly from more permanent sources. Insurance companies are a huge one. GPs are also using things like BDCs, business development companies, and interval funds. These structures are often better suited for the longer term, less liquid nature of private debt.
And the type of lending is expanding too.
Yes, moving beyond just traditional corporate buyouts, getting into asset-backed finance, project finance, even some higher-risk commercial real estate debt, possibly driven by banks looking to shift some assets off their books because of regulations.
How did fundraising look for private debt? Down, but still historically strong.
That's the picture. Down 22% globally to $166 billion. But, and it's a big but, the report stresses that was still the fifth largest fundraising year ever for private debt. The drop was mostly driven by mezzanine fundraising, which fell off a cliff, down 80%.
Was the decline even across regions?
No, it varied. North America down 18%, Europe down 30%, Asia down 43%. Europe and Asia actually have negative 5-year growth rates now in private debt fundraising.
Any key themes in the fundraising environment?
Yeah, manager concentration really increased. The top 5 firms raised almost 40% of the capital in 2024. That's way up from the average. Suggests scale is becoming a real competitive advantage. Bigger firms can offer more, invest more in tech and data.
But investor appetite stayed strong.
Very strong. Highest among all asset classes in the survey, actually. 43% of LPs plan to allocate more to private debt. They like the perceived risk-adjusted returns and the diversification.
How did the actual performance look for LPs already in private debt?
It was, subdued maybe, but very consistent. The pooled IRR was about 6.6% in 2024, and it actually outperformed PE and real estate during that year. A big selling point is the low dispersion in returns.
Meaning less difference between the best and worst performing funds.
Exactly. The gap between top and bottom quartile funds was only about 4.7% for recent vintages, compared to like 15% in PE, so maybe less risk of picking a real dud. Default rates have also stayed lower than in BSLs, potentially due to better risk management, though the report does flag the risk of defaults rising if the economy weakens.
Okay, last asset class, infrastructure. Sounds like another mixed year like real estate, but maybe poised for clear skies ahead.
Mixed but poised is a good way to put it. Fundraising was definitely slower, down 15% to $106 billion, lowest in a decade. Funds took longer to close to a record 26 months on average. And first-time funds really struggled.
But deployment was strong, like really strong.
Very strong, yeah. Capital deployment accelerated significantly. Deal value was up 18%, making it the second highest year ever. Deal count was only up 7%, so the deals were getting bigger. All that activity actually drew down the dry powder reserves by 10%.
NP conviction here is sky high.
Exceptionally high. It's the asset class where the most investors, 46% in the survey, want to increase their allocation. And it's driven by these massive long-term secular trends.
Like what?
Think of global trade growth, needing ports, logistics, and the huge one, the energy transition. The report estimates something like $6.5 trillion per year is needed in investment by 2050 for new physical assets. That's just a colossal pipeline for infrastructure investment.
How are managers approaching infrastructure deals now?
They seem to be hitting their stride again, doing bigger deals. Telecom is hot fiber data centers. Data centers were apparently over half of telecom deal value last year.
And that active ownership theme applies here too.
Absolutely critical. It's competitive, assets are held long-term. So value creation really comes from managing things well, handling complex project timelines, labor, and even, interestingly, expanding the definition of what counts as an infrastructure asset.
Expanding the definition? How?
Well, the report notes managers are increasingly including critical services in the value chain. So not just owning the data center, but maybe the company that does the specialized maintenance for it. Not just the pipeline, but the inspection service. Recognizing the operational side is key.
So despite the fundraising hurdles, the underlying story for infrastructure is really compelling because of those long-term needs.
Exactly. LP conviction is high because of those drivers, and because managers are getting better at creating value through active ownership. Even in riskier areas like brownfield or greenfield deals, fixing up old assets or building new ones, which are becoming a bigger part of the mix.
And certain types of LPs are particularly keen.
Yeah, pension funds have the highest target allocation. They like the predictable long-term returns. But family offices showed the biggest desire to increase allocations, probably because they have really long horizons and don't need immediate liquidity as much.
Okay, so resilience, adaptation, themes across the board, but definitely different flavors in each asset class.
That's right. It's definitely not one size fits all. Now, maybe we can zoom out again and look at some of those big themes that cut across everything.
Good idea. The report talks about alternative assets getting more alternative. That sounds a bit meta. What does it mean?
Yeah, it does sound a bit like that. Basically, it means the sources of capital flowing into private markets are changing and diversifying. It's moving way beyond just the traditional big pension funds and endowments, putting money into standard closed-end funds.
And these other sources are growing faster.
Much faster. The report estimates this alternative capital grew maybe 18–20% in 2024, while traditional AUM grew only about 1%. These alternative forms now make up roughly a third of total private market AUM. It's a really fundamental shift.
Why is this happening now? What's driving it?
A few big things. One is opening up access for retail investors. There's this huge pool of wealth there, maybe $60 trillion untapped. Regulatory changes are helping, like allowing PE in U.S. 401k retirement plans or updates to Europe's LTIF rules. Plus, you've got innovation on the supply side platforms, administrators making it easier for firms to handle retail money.
So it's not just chasing those giant institutional checks anymore.
Not exclusively, no. Second, GPs are creating more customized solutions for their biggest institutional clients, going beyond the standard fund structure. Things like separately managed accounts, SMAs, or co-investments.
Giving LPs more control or specific exposure.
Exactly. More control, direct deal access, maybe different liquidity terms. And third, the market's just bigger and more diverse. Over 17,000 active private market firms globally now. More players players means more varied strategies and capital needs, which spurs innovation in how capital is raised.
What kinds of alternative capital are we talking about?
The report groups them a bit. There are higher liquidity products, think evergreen funds, non-traded REITs, BDCs, interval funds, designed with more frequent options for investors to get money out. Then there are the LP demand-driven products, like those SMAs and co-investments we mentioned, tailored for specific institutions.
And permanent capital.
Right, and that's a big one, largely coming from insurance companies. We're seeing more GPs actually acquiring insurance businesses to use their long-duration balance sheet assets as a stable long-term source of capital for private investments.
That's a major strategic move for a GP.
Huge. It means for GPs, the path forward requires really adapting how they think about fundraising and investor relations. It's not just calling the usual suspects, it's building teams to source capital from all these different pools. It's shifting from just selling a product to providing a solution tailored to specific investor goals.
Okay, shifting gears slightly, but still a cross-market theme. Let's circle back to that private equity exit backlog. That sounds like a real pressure point.
It's historic, according to the report. Bigger than any point in the last 2 decades by value, number of companies, share of portfolio. The average PE firm in 2024 owned more companies, they were valued higher on the books, and they'd held them longer.
And why is that such a big problem, beyond just tying up capital?
Several big challenges. First, like we said, it makes fundraising tough. LPs are holding back new commitments until they see cash coming back from older funds. DPI getting distributions back is now right up there with MOIC as the key metric LPs care about after IRR.
They want to see the cash return.
You got it. Second, holding companies longer puts pressure on returns. To hit the same target IRR over, say, 7 years instead of 5, you need a higher MOIC. You need to sell for more. That's tough when many were bought at high prices already, and you need an even higher exit price in today's market.
And the core problem is that gap in valuations.
Pretty much. Assets on the books are often marked based on older, rosier market conditions. Buyers today, whether corporates or other sponsors, are looking at current financing costs and market realities and aren't willing to pay those older marks.
So what's the playbook? How do sponsors start clearing this backlog?
Well, the report suggests it needs to start way earlier, building exit planning into diligence before you even buy the company, setting realistic timelines. Then, executing that initial value creation plan post-close is key to build momentum.
And you mentioned a mid-cycle plan.
Yeah, this is highlighted as an emerging best practice. After the initial fixes, a mid-cycle value creation plan aims to kick off a second wave of improvements. Critically, it focuses on what the next potential owner will likely value, aligning the business for sale. It often involves focusing on just 2 or 3 big strategic moves and ideally running it alongside a fresh look at the company's valuation, a mid-cycle re-underwrite.
So prepping for the sale well in advance and strategically.
Exactly, and tailoring that prep for different potential buyers. Strategic buyers want synergies. Sponsor-to-sponsor buyers need to see the remaining upside. IPOs need a clear growth story. The key is being ready and flexible.
Okay. Finally, let's talk about secondaries and GP stakes. The report calls these the next wave of private market innovation. Why?
Well, they've become super important because they offer solutions to some of the very problems we've been discussing, especially the need for liquidity and new ways to get capital and exposure.
Starting with secondaries, how do they help with liquidity?
They work for both LPs and GPs. For LPs, it's a way to sell their stake in an older fund if they need cash or want to rebalance. For GPs, it enables these GP-led deals, often using continuation vehicles or CVs.
Ah, the CVs.
Right. A GP essentially moves a company they still like from an old fund into a new vehicle, funded by new secondary capital. Original LPs get a choice: cash out now or roll their stake into the new vehicle. It gives the GP more time and capital for that asset.
And the market's booming.
Absolutely. Secondary deal volume jumped 45% to a record $162 billion in 2024. Both LP sales and GP-led deals were way up. CVs were like 84% of the GP-led volume. Fundraising was strong too, third highest ever, and getting less concentrated among just the biggest players. Pricing also improved, hitting 89% of NAV, which helps get more deals done.
How does performance look for secondaries versus primary PE?
pretty good, according to the report. Secondaries have actually outperformed primary PE in recent vintages. They offer diversification, maybe a bit of a hedge. They had the highest median return among private capital classes in 2024, and importantly, much lower dispersion, meaning more consistent returns. Plus, they give you cash back faster, usually positive cash flow by year 8.
That's compelling if you need liquidity sooner. Okay, what about GP stakes?
GP stakes is investing directly in the management company itself, the GP's business. The GP sells a minority stake to get capital for growth, launching new products, maybe succession planning, plus they get a strategic partner.
And LPs invest in these stakes.
Yes. For LPs, it's a way to get exposure to the overall growth of the private markets industry itself. You're investing in the business, collecting fees, and carry across all its funds, not just one specific fund. The report says it offers an attractive risk-return profile, resilient, proven track record. The survey found 43% of LPs invest in GP stakes funds, and many are thinking about direct stakes too, especially sovereign wealth funds.
How's the fundraising looking there?
It's still relatively new compared to buyout, but growing fast. Fundraising hit $4.4 billion in 2024, way up from 2023, though not quite hitting the 2022 peak, which had some huge fund closes. But the number of GP stakes funds raised hit a record high last year. The pace has really picked up.
And performance, how does that stack up?
This is really interesting. The median performance for recent GP stakes funds is right up there with buyout, which is historically the highest returning PE strategy. But, and this is key, the dispersion of returns is much, much lower, much less difference between the top and bottom funds.
So potentially more consistent returns than trying to pick the winning buyout fund.
That seems to be the suggestion, a potentially less volatile way to get exposure to PE economics.
So both secondaries and GP stakes really feel like strategies evolving out of market needs, providing liquidity, capital, different exposures, and they're growing fast with some attractive traits.
Precisely. Key innovations helping the market adapt and move forward.
Well, we've certainly covered a lot of ground, navigated the weather patterns of the 2024 global private markets, looked at PE, real estate, private debt, infrastructure, and these big cross-cutting themes like alternative capital, the exit challenge, and the rise of secondaries and GP stakes.
Yeah, and the big picture seems clear. Despite the headwinds, despite some slower headline numbers, the market showed real resilience and adaptation in 2024. Deal activity picked up as folks adjusted, the focus really shifted hard towards operational value, and these innovative strategies and capital sources gained serious traction.
And underpinning it all is that strong LP confidence. Investors seem to be looking past short-term bumps, focusing on the long game, the diversification, the asset class's ability to evolve. They're signaling pretty clearly they intend to allocate more.
The market is definitely not standing still. It's transforming.
So, wrapping this up, what does this all mean for you listening to this deep dive? It really suggests the world of private markets is getting, well, more complex, definitely more diverse in where the money comes from, and more sophisticated in how value gets created. Maybe fewer easy wins, much more focus on active management and finding the right solutions.
And maybe a final thought to chew on, building on what the report discusses. When you see the significant growth in alternative capital pools, this intense focus on deep operational value creation, and even the definition of a private market asset expanding to include things like services. How might the fundamental idea of what makes a successful private market investment, or even what defines a successful private markets firm, how might that continue to transform in the years ahead?
Definitely something to think about as the market weather, hopefully, continues to clear.